Whether it's tariffs today or in the previous administration, it was carrots in the form of the IRA. That isn't what really, at the end of the day, will determine the difference. Determine the difference is the economic reality. America has a lower cost of energy than any developed market around the world, and that's a sustainable competitive advantage for at least the next 10 years and probably the next 20 years. So therefore, electric costs and power costs are lower. So energy intensive businesses in North America have a 10 to 20-year competitive advantage.
Before we get started, I just want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Robotti advisors or any of their funds or strategies. Everything is meant to be informative about the fund management industry. Hello, everyone. Welcome to another edition of Other People's Money. I'm joined today by Bob Robotti, President and CIO of Robotti & Company Advisors, a value-focused New York boutique asset manager and one of the increasingly small class of investors who can boast an over 30-year track record. Bob, thank you so much for joining me here today.
Oh, my pleasure. Thanks. Always love talking about what we have a passion for. So thank you.
You clearly do have a passion for it. I got to meet you a few years ago in Omaha for one of the last Berkshire meetings with Warren, and you gave a talk, and a lot of the things that you spoke about, you are still speaking about today, which is quite uncommon. Market narratives shift very quickly these days, and you are a proponent of patient capital, and you really have a long-term holding period compared to pretty much everybody in the market these days. Can you talk to me a little bit about why you believe patient capital is still a value add for investors in increasingly quarter-focused investment landscape?
So there's a phrase that I've come across, and it's by Bernard Baruch, and it says, data and information is no substitute for thinking. And so much today is, news and information flow is just so strong and so heavy. What it does is it helps concentrate down into shorter time frames, people's perspectives. And, that's great because it adds to market volatility. It adds to poor decision making. It adds to misallocation in capital. It adds to valuation issues that provide opportunities for those who can think 3 years, 5 years, 10 years about opportunities, investing in companies, right? It's not buying stocks. It's not trading in some name. And so therefore the world's become more focused on that. The allocation of capital clearly is more passive. You don't buy a stock, you buy an index, you buy something so that you don't know what stock you're buying or selling. So that kind of flow of capital, has clearly laid the groundwork, an opportune set of companies to invest in that have clear demonstrable advantages, very modest valuation, and yet also companies that have, you could understand there are cyclical structural changes that are on the way that potentially really benefit these companies. And therefore there's a long-term opportunity for significant growth. So that's what I joke. I said, today you can buy Ben Graham cigar butt companies that really have great growth in front of them. And for reasons they have barriers to entry and for a long runway of opportunity. So therefore you really have growth stocks that you're buying at very discounted prices. So it's a great time to be an investor if you have the ability to understand what's interested, what's coming, as opposed to where we've been and what's in the past.
There probably are more investors who would agree with you. The problem is that they just don't have the mandate for it, and the investor appetite isn't there. So a lot of it has to do with just
Yeah.
who your investors are and their willingness to trust you. Now,
Yeah.
if you've had relationships with people for 30 years, 20 years, 10 years, it's a lot easier to get them to trust you when you say, it's all going to come back around. We're buying.
Well, it is interesting. So that's right. And that is our advantage, right? The advantage is we can only be as patient as our capital is. And to the extent that we did not have investors with us. And so those investors have been with us. There's a group of them that probably came in like 1999, 2000. So they've been with us 25 years. And the other group is investors is when we started. So they're 40-year people of friends and family. So the capital we have is extremely patient. They have experienced really good returns over time. So therefore it's easier for them also to be patient in that process. So that's a critical differentiator. Clearly 15 years ago, there were a lot of value investors that I knew and thought extremely well of, had also done well in terms of raising capital. And then for when the capital flowed in, therefore what they did and how they invested it, became a little bit problematic and have had dramatic drawdowns because that capital doesn't stay. It's gone away. And therefore you radically change that business. And so many of those businesses are either a fraction of what they used to be or they've gone away. So The competitive landscape is substantially better than what it was.
That is something that I've heard you talk about. You gave a talk to a small group where you mentioned a conversation you had with Chuck Royce, and Chuck was talking to you and he said, I've made money every year and we still get outflows. And if those are the type of people who are interested in the same names, even if they're making money, if they're getting outflows, they have to sell down those names, and that's going to affect the share price.
But pre-conversation, you pointed out that not only Robotti Advisors manages money for people, I started the business 40 plus years ago, and I had audited Tweedy Brown and knew them extremely well from the inception of the launching pad of Tweedy in 1975. And also then worked for Gabelli as his CFO. It was a small firm. And both of those were broker dealers who over time morphed into the asset management business. And so that's what we did too. But the broker dealer side of the business, of course, is really interesting in terms of the information flow we have, because who have we historically had done business with is small cap value managers. And so that universe of potential clients has continued to dwindle and dwindle and dwindle, and then many of them gone away. And Chuck Royce is an example of someone who, if he had a conversation with, he's not looking for a new idea. He's looking for what to sell in his portfolio to meet the redemptions that he is consistently having. And that story is repeated across the small cap value environment of active managers. So it's an interesting information source for us, the broker dealer, who we talk to, and now we have information with really smart, intelligent people who are coming few and fewer between. But there's a new group of people who are getting into the business who have the same passion, have come across, have listened to people like you and Harris and say, gee, this is really something I am passionate about. And so that will continue to happen. And so new things will come too. So
what do you think with Warren stepping back? Do you think like the Berkshire meeting is still going to be a big event that everyone goes to? Are people still going to show up?
And my overall comment on that is nothing other than idle speculation, right? There's really not much value in that. But of course, at the top of the conversation, you kind of can't get away from it. Because if they do, if they don't, that really won't make much difference really in terms of doing bottom-up research, identifying companies, thinking about investing. And, you'll still have all of the concepts of Buffett and how he's invested to be able to apply them and think about it, how it works for you and how the application is. That said, I think that next year I'm open to the idea there's more people who come than normal, because that's the question. What's it going to look like? How's it going to be? So therefore you pique people's interest. And so I just don't see how that means you don't come, because you want to see it. You wanted to see Warren when he said, oh, I have one more thing I want to bring up. So those things definitely will pull people in. And so, I think that definitely the next year I'd be shocked if there were more people who want to come see what happens now.
One thing I have noticed from my conversation with value investors is there is often a similarity in mindset, in investing philosophy. One of the things that I found from reading your letters was the difference in that you actually love industries that are beaten down. Most value investors are trying to find those pockets of value where things are looking good. You seem to be fishing where things are looking bad. Can you speak to me a little bit about why you like industries, companies that are facing headwinds rather than tailwinds?
It's clear enough to think about. You want to identify securities that are mispriced, something that's doing reasonably well, that is a niche that can do somewhat better, is harder to do and harder to time and harder to get the valuations on. Something that is not making money, has no prospect of making money. So, as we, talked about at the grants conference, I talked about in the Zombie 1000, that is part of the Russell. There are so many companies, people say it's a bad index. Well, but it's a great place to hunt for great ideas, right? And so in that Zombie 1000 are companies that you can clearly buy for, it's not 50 cents on a dollar, right? You're buying these businesses for 20 cents on a dollar, 10 cents on a dollar, because no one would build that business because it's not making money and it doesn't have a prospect for it. So what's the catalyst? If there's no catalyst, I don't want to own it.
So within the Zombie 1000, are these declining businesses? Are these businesses that are facing less of a secular headwind, more of a cyclical headwind? How do you discern from a melting ice cube where this is a company that's going to go bankrupt and one that is going through a hard time?
Well, I don't necessarily think it's necessary to distinguish between those two things, because I think you could buy something that eventually over time will be a melting ice cube and still have really great returns, on the investment. But of course, you really are looking for something that is a business that is not in decline, that probably has reasons to believe that it actually has a lot of growth opportunities, right? So the business itself is just cyclically depressed. And yet the future is probably even better than it has been in the past for a multitude of reasons, including not only is the industry potentially, optimally what you want is that it will grow, but clearly the company itself and its position in that industry is vastly different than what it used to be. So yeah, I think people closely identify us with builders first source, a distributor of lumber and lumber sheet goods to the home builders. And it's a perfect example of a business where home building in America is definitely something that's going to increase over time. We need more homes, and on a demographic basis, we'll have more people. So it is a growth business, that was clearly cyclically depressed. But also what happened to that company taking advantage of that, and that's what we believe is businesses going through difficult times. Economics 101 really does matter because that's the catalyst that we believe in. We believe in the catalyst of economics respond to the environment. People shut down, reduce, pull in capital, and then consolidate. And then opportune people can see the opportunities and take advantage of that, and therefore substantially change the earnings power of the business. So not only is Builders First Source transformed from the company it was given what it's consolidated, but the industry is in a different place too. So it's a combination of factors. So in a way, that's the ideal, but it isn't always that because I would say the offshore oil service businesses, which I own, Harris owns, are businesses that are in terminal decline. Now, the question is, what's terminal decline? Is terminal decline a 30, 40-year period of time? And because if it is, then the cash flows in years 50s and 60s, you don't need they're not valued very much today anyway. And in the next 10 years, of course, in those situations, the next 5 years, you're going to generate more than enough cash to get a return on your investment. And so there's a significant window. But of course, you got to be realizing the fact that, this is a business that isn't going to grow. This is in terminal growth. This is in terminal for a number of years flat, and then it's eventually going to decline. But that doesn't mean there isn't huge opportunity for great returns over that period of time.
You talk about the landscape has changed for building products. Obviously, there's a massive new entrant into the space
Yeah.
with Brad Jacobs and QXO. How has his foray into building products and services impacted the landscape?
It is an interesting business in that there are all these verticals, and the verticals don't cross, which is interesting because in having invested in the business, I always thought that was odd and how it would make sense for those verticals to cross. And but the biggest thing I would say about Brad Jacobs' entry into the business is it is an affirmation of the opportunity and the growth in the business. And he's done this because he believes, right, the fundamentals of the business are strong and will grow. And then he also believes by executing, you can take advantage of, and there are opportunities for consolidation and optimization. Of course, in my mind, that all that is an affirmation of, you can invest along with Brad, who paid probably a relatively fair price, I would think, to buy Beacon, to therefore have a platform in which he's going to do a lot of creative, smart things, I am sure. At the same time, of course, you could invest in Builders First Source at a lower discount, lower valuation, and a company that also had an affirmation that it's worth something because the chairman of the company, who's been involved with it since 1998 and has built this business, just went out into the open market and bought a huge amount of stock personally. So therefore, there's an alignment from someone who owns a lot of stock personally running this business, and they have the competitive advantage of the position that they have today is a much better competitive position in its vertical, lumber and lumber sheet goods, than Beacon in its business. So, but to me, it's an affirmation of one of our investments. And once again, someone is saying this is a really good investment that has excellent long-term growth dynamics, and it has valuations and a competitive advantage in its business. And it continues through its own mechanism to try to do more and move outside the envelope and do more things associated instead of just lumber and lumber sheet goods. So doors, windows, sidings, and more things. Of course, the digital solution that they bought 4 or 5 years ago that they've been working on really is, an early stage to try to figure out how to do the whole house solution that will provide more of the products associated with it. So to grow it out organically, with a technology advantage. So he's already doing the things that Brad and have been doing them for 5 years, in a thoughtful, intelligent way. So it seems to be, once again, they've got the head start and they've got the platform that is a bigger, better platform. So, thank you, Brad, for reiterating the fact that we have a really good investment, and sure you do really well, and that's great. And a good, disciplined, competitor in a vertical that they're not in is that, and yet they may try to get into that vertical is really good. Competitive pressures mean people who are well positioned work a little harder too. So I think it's an affirmation of our investment there.
I think the chairman that you're referencing increased his share by over 40%, something like that, at 111 a share, I believe was the transaction. And I actually went to a talk that Brad Jacobs did at the outset of QXO, where he said, he went to consultants, he wanted to do another roll up. Anybody who's familiar with his strategy, and he said he went to these consultants and they gave him said, "What's your number one industry that is primed to be rolled up?" And they said energy. And he's like, "Well, the problem with that is you can't raise any money for it." And he's like, "Okay, well, what's number two?" And building products and services.
Yeah.
So actually the number one that he wanted to roll up, he just said, "I just couldn't raise the money for it."
Right. That was absolutely the best thing with energy. But since the capital won't follow me into that, I'm going to do the second best thing. So that was once again an affirmation of we're invested in the right places. The valuations are really attractive and the opportunity is great.
I want to talk about North American advantage. I mean, that is something that you're obviously heavily focused on, industrials, real products and goods and services in the real economy. And you have for a number of years been highlighting the advantage of North American operations. Obviously, in the current landscape, the policy landscape with tariffs, that is something that the administration is actively trying to encourage is more reindustrialization. I'd be really interested in how your view of the North American advantage has shifted with this new policy.
The North American advantage for industrial purposes, in my mind, is the fact that the U.S. North America has a lower cost of energy than any developed market around the world, and that's a sustainable competitive advantage for at least the next 10 years and probably the next 20 years. And that is natural gas is overly abundant in North America, and that means that natural gas prices here are substantially below where they are in the rest of the world. And that natural gas, one of its main uses is to convert it into electricity. So therefore, electric costs and power costs are lower. So energy intensive businesses in North America have a 10 to 20-year competitive advantage. And since pricing is set by the rest of the world, what that means is an excess profit to be realized by those companies based here. And that is the critical thing. So whether it's tariffs today or in the previous administration, it was carrots in the form of the IRA, that isn't what really at the end of the day will determine the difference. Determine the difference is the economic reality. So that energy advantage, lower cost means, so when the Europeans were complaining 2 years ago about, oh, the IRA is killing us because our European countries are closing down capacity and moving into North America. No, the reason they're moving it here is because you have a really high cost of energy and they have a really low cost here. So they're competitively advantaged. So they're moving here. The IRA is the icing on the cake. You didn't even need it because it was going to happen anyway. And, so it's interesting in my mind how the two presidents, who like the opposite ends of the world, they would say, are really doing the same thing. But the key thing is that advantage exists without giving away carrots or trying to batter it away with sticks. So that will be at the end of the day because administrations will change. And you do something because the government has a policy and therefore tries to incentivize it. That's a risk that government policy doesn't persist or isn't effective. The fact of the matter is the underlying economics are the determinant fact, and that is clear and obvious and sustainable. And so, yes, industries, yes, people say reshoring, things coming to America because they're competitively advantaged. If they're an energy intensive business, makes all the sense in the world because this is the place that has a lower cost of operation. So as opposed to 40 years, 50 years ago, everything left the United States because it had a high cost of operation. So that's what happens. The world's changing and globalization, it evolves. It isn't deglobalizing, just kind of who's competitively advantaged. That advantage changes and it moves. And that reality is what really drives it over time.
So do you think people who are skeptical of reindustrialization are overly focused on the labor cost?
So a great conversation that exemplifies this is talking to Kastenbaum, who ran Stelco, right? Recapped the company, did a phenomenal job, turned it around, ended up selling it to Cleveland Cliffs not long ago. And chatting with him at one time, and that was a union operation that he ran. So the union loved him and he loved the union. And that's what he would say. He said, listen, 10% of, because labor, those energy intensive businesses tend to have relatively low labor cost of goods sold. So he said, it's 10% of my cost of goods sold is labor. If I don't make money, it's because I paid too much for the energy, for the iron ore, for the met coal, for all of the variable costs that I determined. The 10% to labor, that's not, if I cut it by 10% or 20%, I'm changing my cost of goods sold by 2%. What am I doing? How does that work to my advantage? Instead, I want that 10% cost to be hardworking, focused on how I think the business should be run and optimizing the business. So they are my partners and thinking about them that way. So that's what I also think is reindustrialization also means labor has a participation in that process. So what we've spent post the financial crisis, and the government policy has been, the way to incentivize economic activity is only done through the cost of capital. So it's a modern day version of the trickle down effect. If we lower the cost of capital, suddenly people will throw money at things, and you'll have economic expansion. Well, that didn't happen, right? So the Fed policy, everybody talks about the Fed. The Fed, is relatively ineffective. The things that really matter. So I would say Fed policy to induce economic activity was a failure post the financial crisis. And so therefore low interest rates is only one part of the equation. Cost of capital is only one consideration. Are there opportunities for growth in the business? Can I deploy capital? There are a lot of other factors that therefore enter into those decisions. And it wasn't an environment that was conducive to that. And all you did by lowering the interest rate and leaving it there for 10 years was you caused inflation, financial inflation, right? Financial assets appreciated. And then what happens? The 1%ers have more and the 99%ers have less. You've exaggerated and you've accentuated that problem. So now with the reindustrialization, the 99%ers are going to end up getting really good jobs. They're going to participate in that process. So the idea there's a participation in economic advance that will happen. And at the same time, I think it's a really good chance that the way capital is allocated, the 1%ers are going to lose 30% of their money because they're invested in things that were winners in an environment where inflation was low, interest rates fell through the floor, money was given away for free. You allocated capital, you misallocated capital accordingly. And those are huge amounts of capital that have all kinds of valuation risks and have, the future economic environment is not the same thing. And it won't be as conducive it was to all of the good things they've had in the past. So the 1%ers are going to lose 30% of their money. So that'll be, and the 99%ers will kind of like that, the idea that, they get taken down a peg.
What are the industries that you think are definitely going to come back home?
I mentioned Stelco, so we've followed the steel industry for the last 3-4 years. And I do think that, North American steel in many ways is competitively advantaged from the point of view of, we have all the met coal here, we have all the iron ore here, and we have low cost energy. Those are the three variable costs in making steel. We're competitively advantaged in those things. And so I think that's why you saw Nippon Steel, one of the largest steel companies in the world, wanted to buy U.S. Steel because they want to have a bigger participation in a market they see. Not only they think the opportunity is there, but Japanese companies say, we want to manufacture in North America because it's competitively advantaged. So that's where the customer is. So they're looking to get in front of the customer. So that's an affirmation of it's an interesting place and an interesting industry. And the other thing about North American steel is that it's also environmentally advantaged, right? Nobody has the amount of EAF production, and that's what it is, right? An electric arc furnace, EAF, right, produces a ton of steel for a quarter of the CO2 that a blast furnace does. So environmentally, we're better than the rest of the world by far. So we make the lowest CO2 polluting steel in the world, and we do that with locally sourced ingredients that we control. And in a market that I do think that energy advantage means there's more and more activity, and that activity means you need steel. And whether that's for industrial purposes or whether that's for renewables. And so therefore energy and the concern about energy is not going away. And, renewables clearly are part of the equation for and I think the world's need for energy is growing. It will continue to grow. And therefore, you'll continue to need, obviously renewables are part of that solution. And so the steel and cement and all the tangible things needed to do that, the copper, all of these things are fully tapped out today. And yet you're going to increase the consumption of those things because you're going to make more of these things. So it's an interesting time where I think there's all kinds of structural advantages that are changing. who's well positioned, who's the right business, who's going to be able to. And in that process, if we do have inflation and therefore higher interest rates, who also has pricing power. So therefore the supply and demand will determine the pricing power, not inflation in the general world. You can have inflation in the world, but if my product is in high demand and short supply, I have pricing power. So if anything, these companies potentially are part of the cause of inflation. They're the beneficiaries of inflation because you need more of what they have and it is in short supply. So therefore they have pricing power.
So industrials, what about slightly more advanced manufacturing?
Yeah, I think so. I think, at different points, different places along the line. So I think there's a lot of things. Well, I also think clearly chemicals are advantage. I think fertilizers advantage. Fertilizers advantaged also. And also there's a structural change going on in the fertilizer business because all fertilizers start with making ammonia. And the new uses of ammonia in terms of energy transition, whether that's going to be as a marine fuel, whether that's going to be blending it with coal to therefore reduce the coal burn and power generation. So all these things are increasing new uses of ammonia, whether ammonia is a facilitator for hydrogen and the use of hydrogen, which will also grow over time too. So there's a lot of incremental uses so that industry not only is competitively advantaged if they're making fertilizers here, ammonia, but ammonia's uses are continuing to expand to other things. So there's all kinds of organic growth from the fundamental product that well positioned. And in that regard, one of the companies we like and we own, and I've been wrong for a long time, is this LSB Industries, which I think is one of the smaller competitors in that space. But I think that it's well managed. The owners really understand the opportunity. The valuation is extremely discounted. You can buy this company for, and I don't know if it's 20 cents in a dollar for what it would cost to build the capacity they have, which is competitively advantaged, positioned here in North America, and has potential growth opportunities, right? There was a project that has come and gone, but no, it probably will come back, and that is making more ammonia here for exportation to other markets. So that's an example, again, of another industry. The CF Industries, of course, is the nameplate in domestic production of fertilizers, and a good company with a very modest valuation on it. And so, but LSB is the one that we think is particularly interesting.
You talked about that cost of replacement metric. I'd love to get into that a little bit more. I mean, how important is looking at what is the idea of what is it going to cost for somebody to go out and start this business from scratch compared to what I can buy an existing business for today? How often is that a metric that you're looking at when you're evaluating a business?
Frequently, right? So when you're looking at a business that isn't making money, what's it worth? And and people do things like, well, it used to trade at 7 times EBITDA, and I think the EBITDA could be this, and so they have to use metrics. So Builder's First Source was like a perfect. So of course, we invested in Builder's First Source, and then from that, we found the competitor that had come through bankruptcy, and we invested in BMC and owned 22% of the company. So when people would think about the industries, I'm like, there's no template for what this company is going to earn because what it did in the past and what that business was in the past is not the same as what it is today. So you really have to think about it in a different framework to understand what the earnings power of this business is. So that's a repeatable pattern though, and that's what we also think is that when you're buying things that are zombies, that aren't making money, all of those things, if the business and industry is one in which we have a high conviction that the level of activity at least returns to where it was, in looking at what it would cost to build a facility to get into it is an indication as to over time where the earnings power is going to go in that business. And so therefore that's the true north. So whether that was buying boats when they weren't making any money, you didn't want to own a boat. And if you could buy a boat for 20% or 10% of what it would cost to build that boat, that is a relevant economic metric. Of course, what you don't know is you don't know the time frame. But again, when you buy it at 10 cents and 20 cents and a dollar, you can have an awful long time frame and have a tremendous return on investment. And yet that's where it will go because at some point you will need incremental capacity. And therefore, what does it cost to build that? Can you build that? One of the industries that we're have invested in, and hasn't worked for us the last 2 years has been lumber business. Right, it went into a decline 2 years ago, and therefore we think there's great opportunities because you could buy a lumber business. We think today for a fraction of what it would cost to build that business, and we think the normalized earnings power of the business is you're buying them at 2 times earnings. So these things are extremely attractive, but in the meantime, they lose money, they continue to lose money, they go down, and so people don't want to own them. And so again, you're buying it for a fraction of what it's worth, and yeah, lumber and the use of lumber is something that's an increasing product over time. And what happens is the same thing. The last 2 years, given pricing has been terrible, at break even, below break even, capacity has been taken out of the market. So you permanently reduce substantial amount of the capacity. That happened, large pieces of it in 2024 continue to happen today. So you continue to take capacity out to therefore bring capacity down below a normalized level of demand. And so therefore, when demand returns to where it is, the earnings power of that business today, we say, is probably even better than what it used to be, because there is less capacity available and the market will absorb all of that capacity and need more capacity. And where does it get it? How does that happen? So we repeatedly, we have the North Star of what does it cost to replace that business, that asset? And that's the relevant point that earnings return to over time. And if the staying power of the business and its ability to do things when things are down and potentially increase capacity is an opportune place that should get you really great annualized rates of return.
Okay. So you said lumber's been struggling. Obviously, Builders First Source has pulled back with, rates staying higher than a lot of people anticipated. The housing market has been relatively slow compared to what it was before. I'm sure lumber maybe not as directly tied as building products, but pretty closely tied to the housing cycle. I mean, how has that affected the industries that you're focused on right now?
Lumber and lumber sheet goods are the vertical that Builders First Source is in. And so lower prices for lumber means lower profits, right? Because they make percentage of it. The percentage doesn't change so much, really. And so, but as the price is $350 a board foot instead of $700 a board foot, you make half the profit. And so therefore the pricing is a clear, relevant thing. So the earnings today are depressed because volumes are a little bit light, but also the pricing is low. And so there's the earnings power of the business in a normal pricing environment for lumber, which we'll get to before we get to probably a strong market, because you continue to take capacity out of the market. So you're right sizing capacity. So pricing gets back to $500 a board foot, which is probably what the industry needs to have reasonable return on capital. And so that's where we think it goes to. So therefore there's an uplift that comes from that. And what inevitably happens in cyclical businesses like this, especially as you reduce capacity, you never move it to the right place. You go too far. And there's a high degree of probability that when demand comes back, you're going to end up with pricing moving up significantly to therefore send messages to the market, to therefore produce more to bring it onto the market. And you can't turn that around quickly. So, as it takes time, that means prices rise beyond the normalized level too. They go below it. And of course, we saw that 2-3 years ago where lumber prices went as high as $1,600 a board foot. So, Builders First Source minted money in that environment. And that kind of environment, it's priming up to do that again. You've cleared out the inventory, you're reducing capacity. In the meantime, builders, is well positioned to distribute and continue to make money in any pricing environment. And will participate on the upside, although the lumber companies clearly have a lot more leverage to lumber prices and profitability.
I remember that period when lumber was the eggs. It was the commodity that was getting front page news for how high the prices had gone. But I want to switch here a little bit to how you manage positions after you've identified a business that you think is attractive for all of these reasons that we've discussed.
Sure.
Both engaging with management and also trading around as things get overstretched, as you said they tend to do. I know you've traded around your Builders First Source position as it's run up, as it's come down. Same thing with Tidewater. But you've also engaged with management over time, consistently. So I want to talk about both of those aspects.
Well, since we're into these businesses when it isn't making money and there's a long runway of opportunity, it's also, we think, great. Because what ends up happening is, Builders First Source, when I visited them in May of 2009 down in Dallas and met with the CFO had no problem meeting with me because no one wanted to talk to him. And so therefore, you get to talk to the senior management because it's like the Maytag repairman. Nobody talks to them. Nobody's interested in them. And so therefore you can develop relationships. In the meantime, there clearly is a long runway of opportunity. So therefore, to spend time to understand the people, the competitors, the dynamics, and the people are a critical part of the equation, right? Who's the company that has the people that have the vision to be able to execute? Because clearly Builders First Source advantage is the chairman of the company, Paul Levy, understood this opportunity and continued at various times to be able to push them to execute, to lever up to buy ProBuild in 2015, right? You continue to look at, when I was on the board of BMC back in 12, 13, 14, I knew that Floyd Sherman, who ran Builders First Source, was interested in Builders First Source. The footprint of the businesses fit together, in terms of one, they both were in Texas and one went west and one went east, to smile across the whole the part of the country that there's all kinds of development opportunity and new home building in. So, and eventually amalgamating and consolidating in with Builders First Source. So all of those things are critical elements to people. And I also said to Paul Levy not long ago, I said, Paul, the best thing that happened to Builders First Source is the business took longer to recover than everybody thought. Because by 2015, which of course the bottom was, in 09. So here you are 6 years into a recovery, but the recovery was a slow recovery and therefore still difficult. So you had the Johnson family who owned ProBuild saying, that's it. I'm not writing another check for $100 million to keep this business in business. I capitulate at the bottom of the market. So they capitulated at the bottom of the market. And Paul went out and levered up the company and said, this is the time to do it. So, very opportunistically took advantage of that and therefore helped transform the business. So those are critical elements to get the right people too, because the right people with the right assets really substantially changed the earnings opportunity of the business.
Obviously, this is an opportunity where you went in, you spoke the same language, you saw things the same way. What about times when you go in and they are stuck in the sand and they maybe don't see it? Do you get more aggressive with your activism? Have you ever, fought change management in a business that you felt was going to turn around, but there was a problem with management?
Hard to do, really hard to do, right? It is problematic, and maybe some people might even disagree with me, but I actually think I have a problem in terms of my personality. That's not my personality to be that aggressive, and so therefore it's hard for me, even if I think that's the case. What I also will say is, what's one of the factual questions you want to, how critical is it, would you invest in a business? Does it have a good manager and all those kinds of things? So, with the benefit of hindsight and the proximity of information that I had, here I accumulated 22% of BMC. I and two colleagues did, and joined the board, and therefore being on the board of the company. And, the person who was the CEO at the time, I don't think it was the optimal selection of CEO, and I don't think he fully understood the business. The fact of the matter was the business was in a position and in a place, and that's what it is. It is also that business is one in which the guy who runs the market in Denver and the relationships he has with those customers, and the guy who runs it in Jacksonville, and the guy who runs it in Seattle, it's a very decentralized business. In many ways, they're the critical elements to the success of that company. And who's in the CEO offices, the allocation of capital and growth of the business, and those opportunities present themselves, and being aggressive to execute on them, is an important component. But you can have a company, I'd say, that the manager isn't the right manager. And in that situation, my co-owner, who had a bigger position than I, was a hedge fund who also was looking, had invested in '09, was looking for an exit, right? Because, they are transitory owners. And so therefore they invested well. It was bought really cheaply. They had made a lot of money. And so they looked to move on, as opposed to, our interest was, well, gee, we think this is a really long dated opportunity. And therefore, we have no timeline on our investment. So therefore we want to be invested in as long as we think the price to value is substantially discounted, and the growth opportunity is clear and demonstrable and really interesting. So, he didn't want to change out the management, because changing out the management would have then pushed back the ability to probably monetize this thing another 2 years. So therefore, he has to weigh those things off in the process.
So you like to find horses that are so fast they could win with a 200-pound jockey.
Well, it is good. That may not happen. It's a combination of factors, right?
When you're invested in a company for so long, there are bound to be big run-ups and big pullbacks, and being active on both sides of those is very important for improving long-term returns.
That, I will tell you, is not of my nature. And so instead, of course, what I've gotten, so I have a famous investment I talk about. My biggest loss ever was an investment I made in a company called, it's today called New Market. At the time was called Ethel Corporation, controlled by the Gottwald family. And that's what happened was, I bought it they bought back stock at 45. I took that as a cue, since the Gottwalds are really smart. They didn't sell any stock. They bought that out from a little coup. They thought that was much less than the business was worth. A year later, I could buy it at 35. So I thought, patting myself on the back, I'm pretty smart. I bought it for less than what the God will think this business is worth at a discount. It proceeded to have a tough time for a multitude of reasons and go to 4. Yeah, so, but in that process, it's interesting. People talk about what's your sell discipline, and they say, well, I recently was on a panel with someone, and they said, well, at 5% we, look at it. At 10% we totally re-underwrite the investment. At 20% we're out. And so I'm like, at 5% I couldn't care less. At 10% I don't even know if I noticed. At 20% I'm like, oh, maybe I should look at it again. So we have, of course, clearly the opposite reaction. And even in businesses going through difficult times, we find that the price moves in advance of how difficult it tends to be. And so we bought more of the 35 all the way down to 4. But it recovers to 15. At 15, now everything's cleaned up. The balance sheet is really strong. The business is turned. The consolidation that they were participating in before they did the buyback has come to fruition. There are 4 competitors in an oligopoly thing rationally competing in a very rational manner. And I say, next year, I'm talking to the CFO, and I say, next year, you're going to earn $4. You're a $15 stock. Like, you're way undervalued. And the CFO, nobody else talked to the CFO of Newmarket at the time, for David Fiorenza. Nobody called him up. Nobody cares about the company. It's like forgotten. And so, yeah, and yet I know him for 5 years. And so we've been there. So, we have, and of course, it's interesting when you invest in these big companies, you can appreciate. So he, of course, couldn't see the forest for the trees, right? Because in the last couple of years, like, he was at times where, I don't know, we may have to restructure the company. We have all kinds of issues. So every day he sees a new tree because he runs into a new tree. He can't see the forest necessarily and say, so he says, Bob, from your lips to God's ears, we're going to do $4. And of course, next year they did $4. And so I bought it at 15. I loaded it up. I made it over a 5% position. And I'm feeling really smart. And then I started to sell it. And I started to sell it at 42. I'm like, yeah, it's 42 on $4 of free cash flow. Business is industrial business, pretty much. The fact of the matter was the runway of opportunity and the consolidation was just beginning. And so here I am selling stock, and they start to buy back stock at 48. And I sell some more stock. I sold at 62. So eventually, no, it was 8 years later. So this is all happening in 05. And by 13, we got a $25 dividend, and I sold it for $275 a share. So the stock went to $300. And so the loss I incurred by patting myself on the back, how clever I was in selling the stock, when that's what it is. You bought it for 10 cents in a dollar. And so selling it at 20 cents in a dollar isn't really very intelligent. So therefore, we really do think there's opportunities, and it's the price to value is really the determinant for, do we sell a position or not portfolio sizing, all those kinds of things. So all of that, because you asked me, like, how do we get into these positions and how do we do it? So we want to stay in for a long period of time. We still probably enter in too soon, because if they are trading at 10 cents, it's almost like, I think, again, it's a Bernard Baruch. You don't want to be in for the first 20%. You don't want to be in for the last 20%. It's the 60% in between. So therefore, the idea that we would wade into these things more slowly, knowing it's difficult, and in the difficult times, things probably get worse before they get better. There will be opportunities to come. So deploying capital is, better wait till you see the whites of their eyes. So easy to say, hard to do, especially since, you see the opportunity. And so, 20 cents, you got to get tempted. You don't know it's going to, it'll stay there and go to 10. Although I've spoken too long here on a diatribe, but recently we did that with a company called 5 Point Holdings. We waited, we saw the whites of the eyes. The whites were close. They were right on us. And at the last moment, we had the opportunity to therefore deploy a significant amount of capital in something that we had been watching, was clear, totally mispriced, and now suddenly was in the reaping phase as opposed to the latency. It will happen. It will come.
It sounds like it's something you've gotten better at over time. Waiting.
I would say I got better at it, but I just got lucky just recently. To now say, yes, I'm smart enough, I'm going to do that on a regular basis is easy to say and hard to execute in practice.
Well, a lot of people, they think about, okay, when you come into a stock, you first buy, if you've got a typical like position size at cost for your average position, maybe you buy a third and then you buy another third,
Right.
and then you buy a third. So for you, what is that like? If you know that you have this tendency to be early, are you buying a 10th, a 20th, like, and then before you get to your full at cost position size?
Well, in this case, with the 5 Point Holdings, we did what we did the whole thing. This thing was 2 years past it turning. It had turned. There was and not only had it turned, you could see the continued reaping that was going to come from this thing. So, and that one, we went all in. We didn't say, well, let's wade into this thing. And it was an opportunity to do it. But you did the reason I went to that whole long diatribe. You did ask me about trading around positions, and I said normally that's not my intent to trade around a position because I don't know, if it's up, if I had sold new market at some point and then gotten back in, would I get back in or would I miss it and have gone higher? You don't know when the pullbacks come. And so it's another thing if the pullbacks do come and you do have capital and you put more into it. But in today's world, that's particularly opportune. So trading around the builders or trading around Tidewater, and I'd hardly say that I traded around it, but what happens is the flow of capital is predicated on some externality and not the fundamental analysis. So stocks go, when they suddenly have runs, they go too far, too soon. And so that's what I clearly believe was Tidewater's situation. It went too far, too soon. So the business was recovering. It recovered dramatically. People could see the opportunity and see where its potential is and where it's likely to be sometime in the next 2 to 3 years, and therefore started to pay forward for that. But even that ascribes too much intelligence to the purchasing. So when it did well, it then got added to the S&P 600 small cap index. So we figured internally at the company, we figured the amount of capital that is indexed to the S&P small cap index meant that the market had to buy 6 million shares of a company with 52 million shares outstanding, without regard to what happened with the business, right? So therefore, that capital was going to buy that stock without regard to price. So they were price indifferent. They had to own this thing. And then, of course, once that happened, the momentum in the stock drew all this capital into it. So therefore, it probably should have stopped at 70 or 80. Instead, it went over 100. And so therefore, when it went to those prices, we did have an opportunity in a window because, again, we're insiders. And so therefore, that limits when we can buy and sell the stock. And so we did sell a small piece of our position. But again, it was something at the margin we did, and it wasn't a big piece of our position because I still have that long-term focus on the opportunity set and the valuation in my mind, and the achievability in the next 3 to 4 years is going to be, that will be a modest valuation based on where I think the earnings can go for the business. Builders FirstSource it's been more volatile for longer because it's been more successful. So therefore, here it is at 110, 115. A year ago, stock was over 200. And so therefore, at 200, the valuation also got fuller. And so therefore, for us to sell more of our position also was easier to do, as opposed to when we did sell Tidewater, we didn't think the valuation was full. We just thought it was opportune to be able to do that. So those are similar and may look to the outside observer, but different in terms of how we thought about it and what our analysis was. And our sale of Builders FirstSource was a much larger percentage of what we owned when it traded approaching 200 and over 200.
We've talked about your temperament a little bit and how that affects your investment decisions. And I imagine it's probably easy for you to buy back in when something has gone lower. What about when something goes higher and you make a choice to sell something because you think it's opportune? Maybe not because you think the valuation is full, but just because you think it's run too far too soon. Do you have the temperament to buy back in at a higher price?
Yes. And again, I would probably point out Tidewater is an example of that, right? So therefore, going back, I don't know, 3 years ago, it was right around when we were, there was a lot of opportunity. So I think I bought a stock at 11 and 12. And then we announced the transaction with Swire Pacific. And again, another situation where what you want to do, invest in businesses that have the balance sheet and the temperament that understand the opportunity as the business starts to recover, and not like, oh, well, I could have bought it for less money a year ago, so I won't buy it today. So, we bought the Swire Pacific fleet. But of course, that was partially because the company had been negotiating with for 2 years. And so therefore it came to fruition then. And the sale was a terrible sale by Swire Pacific. It was capitulation at the bottom of the market. They had actually cleaned it up. They had tried to sell it a couple of years before. The prices that they were offered, they didn't like, they didn't think was a full price. I'm sure that we ended up buying it for less than what Charles Fabricant was looking to buy for. They were going to sell it to him potentially 3 years earlier because they just didn't want to own it anymore. So you got to buy for $200 million, something worth $2 billion to replace it. So you buy it at 10 cents at a dollar. So, that opportunity kind of came to Tidewater. But when that happened, then part of the, and of course, we didn't pay $200 million to buy the Swire Pacific fleet. We paid more than that because what we did was we paid a third of it in cash, but we paid two-thirds of it with a warrant that effectively was common stock. So we definitely use common shares. And that's what happens when you use common shares. You don't know the price at which you're paying. So, what's the really value of the business? Substantially, we would believe substantially more. That's why we're investing in this business also. Now, there was probably an arbitrage clearly on what we were paying for those assets and what our assets were worth at the time. And this is the advantage of the synergies we got from multitude, whether that's cost, operations, integration, market share participation, therefore the ability to uh, accelerate the pricing improvement that was happening given the supply demand dynamics. A lot of things happen. So it made sense to do that, but it was more money. So then Swire Pacific fortunately comes back and, they weren't in it to own stock in Tidewater. They were in it to participate, and they thought there would be a positive uplift in the stock where there was. And so they came back at 17 and did a secondary. And of course, it's great. They did a secondary. It was messy. Who wants to invest in the company? So I think the stock was probably 2021 when they decided to do this. The next thing you know, the stock's at 18. The next thing you have to price the deal at 17. So what 10% of the piece they sold in the offering? And clearly the investment banker loved having an insider who participated in the process. So therefore to the others, they could go to all these other buyers and say, well, you want to participate because after all, he's buying the stock too. You're on the same side. And so I bought it at 17. And then long after they got rid of the rest of their stock, it had traded into the mid 30s and then it backed off and we ended up buying that at 30. So I bought it continually at higher prices, but it wasn't just smart because 30, it's almost back at down. Now here it is at 40. So my purchases look so smart today. Of course, it's still a fraction of what the thing's worth. It's a great purchase. But also I had, because I owned it pre the restructuring, had warrants that struck at 65. And so I also exercised my warrants at 65, even though stock was trading really at that level. So it wasn't an in the market deal that it was like a phenomenal deal. But to be able to deploy capital when I have limited windows of opportunity at a valuation that I thought is clearly attractive and still believed to be attractive today, even though you can buy much less than that. I did that. So I have bought stock at higher prices because having done this as long as I have, I understand there is a really long runway of opportunity and it's never a straight line to get there. There's bumps along the way in cyclical businesses. And when things slow down, the market will say, that's it. It's the end of the cycle of this thing. Get out of it, get out of it, get out of it. So the downward movements, if you look at the chart of Builders First Source, in the 10-year period, through the last number of years, there have been 3 or 4 periods of time where the stock pulled down almost 50%. And so those were great opportunities to deploy more capital into something that was in the process of developing and working out at valuations that were modest even at the time. And therefore, just having the ability to understand you're in the 4th inning. This is not the 9th inning. This is not overtime. So therefore, you can do that. And it's still on a price to value equation and an opportunity set, a great deployment of capital and something you have knowledge and conviction of and understanding of, and is in the process of working out.
I must admit, I feel a bit a wolf in sheep's clothing because I like to short BLDR on those pullbacks. My temperament is I like the unwinds of these long running things. I can't stay in it, but I like the unwinds. And so I'm actually actively, I have some puts on BLDR that I've been playing. It's been very fruitful for me. So I didn't want to drop it too early, but
Hey, you help your movement helps with the movement of the stock price down further. And so therefore, because it worked, so therefore, what you're doing made sense. So therefore more capital goes in and does the same thing. And then it creates the opportunity therefore to buy. So there's something for everybody in that process. So,
and it's funny, I talked
it's
to
good to know someone who's profiting for that process. That's great.
Yeah, and I was talking to a buddy about it. He's like, it's such a good business. I'm like, I know. That's why I'm short, because there's so many people. There's plenty of sellers left. There's plenty of sellers left because it's such a good business.
Right.
But there will come a price. There will come a price where I'll probably take the other side too.
You just admitted you're doing the same thing with Tidewater from time to time also. But
No,
wow, okay.
Tidewater, the drillers,
Okay.
I don't know enough. It's too complex. I mean, there's enough tie through to housing with
Yeah.
BLDR.
So there's the opportunity. Not only do you have many fewer value investors today doing bottom up stock research, thinking about these things, the ones that are left hate cyclicals, hate commodities. I'll talk to someone and they'll say, Tidewater seems really interesting, but I don't
do
get
that.
energy.
Yeah.
I can't. So therefore, people realize they don't have kind of the knowledge base and information to do that. So therefore, the amount of people who can say intuitively, I know it must make sense, but that's not what I do, is a very long list of things. So therefore, who's looking and who is willing to commit capital is a very small group of people today, which affects pricing and therefore affects profit opportunities. Right.
So I want to switch a little bit here to the business side. We alluded to it earlier, but I didn't know that you actually started out as the broker dealer and then the advisor came later.
No, they were concurrent things. We always had both things. We did that. Tweedy's business,
Okay.
Gabelli's business. So I started to work for Gabelli in 1980, 80 to 83. And so he started in 77. And so when I started in 80, the main economics of his business was doing institutional brokerage business. So he was an institutional analyst, at sell side firms. And so he had relationships and therefore was doing, that business. So he started to build the asset management business. So when I started, it was $7 million is what he managed in 1980. And when I left in 83, started my own firm, it was still only $77 million. So the economics of his business were still the brokerage business. And of course, but the research ideas that he had were phenomenal ideas because he was a great investor. So therefore, to internalize that and therefore to build out the asset management business is clearly intuitive and logical because it's a better business that has persistency and growth in the assets as opposed to a transactional business. So it grew. But of course, Cabelli still keeps the broker dealer, although I don't know what it's a non-function today because it really ties more into like a relationship building than it is because it's a terrible group. Who the hell wants to do brokerage business with small cap value managers? They have low turnover,
Yeah, they don't trade.
and of course there's fewer of them. So therefore the universe is small. So therefore it's like trying to do business with, people who don't have any business to do. So it's interesting. So he's still in both business. Tweedy, of course, had gotten rid of the brokerage business, closed it down, and they had started the partnership and it had started to grow. And that's what happened in 1975, right? That's the huge market rotation. So that's when value investing started to perform and outperform dramatically and eventually got the name value investing. Right before that, didn't even have that name.
It was just
Right.
investing.
Right. And so that's what it was. So me, I just had been so fortunate. I got so lucky. It is right place, right there. I graduated college. Hmm. Senior year, I do an internship working the Pastorino Puglisi, the accounting firm, working on the order to Tweedy Brown. And so this is the opening gun for value investing. So I won't get to a place and talk to all the principals of like one of the firms that is helping to make this universe something that is extremely well known where everybody's putting capital to work in it.
Obviously, Gabelli is still around and still very successful. But a lot of people from that era did not manage to continue to perform well through this new period of time. So what do you think it is about yourself and people like Gabelli who have been able to keep things going through this period where value has been out of favor?
I guess we've been fortunate enough he's definitely fortunate enough to have enough money where he can afford to do it. And it's a passion and a vocation for him. And of course, for us, what we found is that having the broker dealer business is a great training ground, introduction ground. So therefore, there have been multiple people who started at a broker dealer talking to people and coming up with how to do research and think about it. So, the first one is Mario Sabelli, who runs Marathon Partners, extremely successful. He's got a record of outperformance of the market over an extended amount of time. And so he did it originally as a sell side person, developed his own ideas, realized his ideas were as good as my ideas, in many cases better than my ideas, but trained in that process and thinks in the right concept and eventually started a partnership. And so Jeff Jacobowitz is another guy who runs Simcoe Asset Management, very successful firm. Again, a record of outperformance, started to work for us in the broker-dealer side of the business, and therefore over time grew that out and then started a partnership and therefore has been extremely successful with managing money. So there's been others that also came to Chris Sansone is another person who's done that same thing. Two young guys where they were in college, the Ben Stein and Zach Sternberg run a firm called Spruce House Capital. Again, came through the firm, started there.
But there's been a lot of commentary about how hard it is for people who are on the equity research side, on the sell side, to move over to the buy side these days. Do you still think that that's a path for young people in the industry to get into the buy side?
It's a lot harder to do for a lot of multitude of reasons. It's not as easy as what we used to do. Although even today, we still there are templates for us to continue to do that. And we think there's still opportunity because we understand the longer view and the opportunity to do that. And we know that's what people want to do. They want to they want to run their own partnership. They want to invest.
So when a bright-eyed young person starts off at Robotti Securities, what are the things that they think they know that just ain't so, that you have found increasingly you have to dissuade them of?
Well,
Um,
no, that's not what it is. I don't not. I am a very laissez-faire manager, and so if you're not motivated and hungry, I'm not going to teach you how to do it. Now, I'll regularly talk to you. We'll talk to companies together. You can glean whatever intelligence I may have, which is probably limited, whatever else. So, but you have to do that, and you do it in your own way. So, Sibeli is a really good example. So, a lot of the companies he invests in are not the companies that we would invest in, and so therefore, his application of how do you think about margin to safety, valuations, analysis on businesses, what kind of businesses are you comfortable with? You have core competency or not, can be very different. So I'm not going to necessarily teach you and show you what to do. You can understand the framework because you could read plenty of things in terms of investing, value investing, and kind of the concepts behind it and how it works. But you have to figure out how to then do the application of that. Like, you may run in a way that's funny, but you may be the fastest runner, and I'm not going to show you how to run. You figure out how to run.
there's not like the Robotti way, and everybody comes in and they learn the Robotti way. It's very much through osmosis and through experience.
Well, you initially probably do run the Robotti way. Like, what does Bob like? Why does he like it? Whatever else. But of course, you're not looking, most people aren't looking to parrot what Bob does. They're looking to have the original idea. And so therefore they look around and they find this thing. And then, of course, the combination of factors, if they find this thing, they come to me and say, hey, this thing looks really interesting. What do you think? Because, obviously the nature of people, it's not, me personally, is to get affirmation from someone that they think understands what they're doing also is a good thing. So they're looking for affirmation from a multitude of things. So therefore, but how they think about it and how they apply it is their own. And that's what makes them really successful and really compelling investors. And that's what we're looking for, people who are really thoughtful investors on their own. Right.
Now, on the advisor side, are you allowed to invest in the ideas that you come up with, at the broker dealer? How does that work?
We're not a high trading organization where we're, pitching a stock. And, first off, the stocks we pitch probably go down first. So therefore, it's not like, we're running an idea. Well, if we did, we'd probably we'd lose money in it on a regular basis. And of course, that's what it is the broker dealer ends up talking to people about things that we're invested in. And so there's clearly a conflict of interest. We talk your own book. Of course we are. But there are things that, we're doing it to try to get a commission out of you, because that is not an economic venture. We're really doing it because we're sharing an idea that we think makes sense, that we have our own capital. So we're, I think, clearly aligned in the things. And, and that's probably interesting too, because you might say, of course, well, Bob loves that thing too much, therefore he may still like it, but I'm going to sell my pieces of it, which is perfectly fine. You make your own decision, whatever else you don't execute an order because I told you to. I share an idea with you. If you think that that is a thoughtful idea, or any of the other people who work at the firm, if they have an idea they share with you that they think is a compelling opportunity, you make your own decision as a portfolio manager. You're not being induced into it. You're not buying it because that Goldman's going to put it on the recommended list or something like that. Robotti puts it on the recommended list. I mean, who cares? So we don't move markets, and so therefore a lot of those things are kind of like industry structural things and not specific to kind of what our business model is and how it really works and concerns that someone should really have.
Well, it's interesting you talk about, oh, they're just talking their book. I've interviewed people, some of them, run money. They have a book and they could be talking their book. And then you have people who just do research. And then the criticism of them is, oh, well, they have no skin in the game. Bring on a guy who has money. And I feel like either way I go, I'm either bringing on somebody who's talking their book, or I'm bringing on somebody with no skin in the game. And either way, there's always a criticism. And, it's up to the person to decide.
You can make excuses. You need to make it. You have to think about what you think makes sense, and that's your decision, not someone else's.
Yeah. Now, I do have a question about, LPs on the advisor side. I imagine you've had LPs for long enough that you've probably had some who've passed away, and the money has gone to the next generation of people. How do you deal with like succession of LPs when you have such long-standing relationships? Do you find yourself dealing with the children of your older investors?
Absolutely, that's part of the process, and you as they and it's their decisions to make as to what they want to do, and there's a multitude of things that go into that decision making. So that's what it is. Is to a certain extent, of course, the the problem I have in recent years is right. I have the great thing about having invested for 40 plus years is that everybody has a life cycle. We'll have an exit date, and so therefore the combination of factors, whether you retire and therefore you need to take money out, well, a multitude of things happen, or you die, and so therefore, then your beneficiaries may or may not want to be invested in it, and so therefore some leave, some stay, and that's just a reality. Which also means that there is some constant churn of the capital, and in addition, the other churn of capital is, the last number of years have been particularly good years. So we've been able to reap some significant rewards of things that we've invested in for a long time. So there's taxes to pay, and so I too take money out of the partnership to pay my taxes because that's an obligation. So there's the growth in our assets over the last number of years has been mitigated by the fact that there's an outflow of capital when the life cycle of our investors and the tax obligations, and it's been frustrating because the fact is here I have a 40 plus year track record of outperforming the S&P 500 and difficult to raise money. I haven't really, in the last year or two, we found one or two people who've invested with us. But before that, and it definitely there was a significant amount of time post the financial crisis where our performance was less than what the S&P is, which is interesting because, of course, the S&P, here it is. It's an anomaly that we think about it just as an indication of the U.S. market, but the fact of the matter is it's the best market to work for an extended amount of time. So you are measuring up against the highest thing to, be outperforming against. So, there definitely was that. Well, that was a mitigated loss of capital, even an extended period of underperformance, but the life cycle is that's inescapable.
I want to close with a question about benchmarks. Obviously, you are value focused. You've talked about, you think that the Russell 2000, although it's been correctly identified as an index full of zombies, has maybe been maligned a little bit. But how do you think about measuring your performance? Do you think that even if you are a value investor, you should be comparing yourself to the S&P 500?
I've always compared our performance to the S&P 500 because that's what it is. The belief I always had was, why would I invest in a subsegment of the market that's a little bit esoteric if I'm not going to do better than if I can do better in the thing that's the broad base and well known, and I know the companies. Why would I do that instead of doing this odd thing? So the only reason to do an odd thing is that the odd thing over time outperforms the index. So I've always thought the S&P 500 is the index in which, because that's what it is. We're here in America, and so people in America clearly can invest in the S&P 500. So if you can't outperform what anybody can do, then no expectation you should get capital, be able to keep capital. Because why would people suboptimally allocate? And yes, you may say that over time the Russell outperforms, and therefore I'll do that over time. Of course, the longer it hasn't outperformed, the harder it is to believe that that's the case. There's something that's changed, fundamental, and so therefore capital flows. And I do think that's a huge issue today, right? That we have gone through an extended period of time. So for extended, right, the extended amount of time is, right, 1982 was the peak in interest rates. The 1980 was the peak in inflation. And this anomalistic period where you had for 50 years, 40 years, 50 years, inflation go one way and interest rates go one way only, as opposed to they normally cycle. It didn't cycle. And to do it for as long as it did, the conviction is, well, this is the way it is. This is the new norm. This is the standard, as opposed to, no, that was an anomaly. This is the end of a period of time. And there's the risk that there really is a more normal environment. And a more normal environment, there's some inflation. That's a regular recurring thing. And normally it doesn't go from it disappearing to just a little. Things tend to go in extremes. And therefore the idea that there's a risk that, oh no, it could peak up quite a bit, inflation be higher. And therefore inflation determines interest rates, not the Fed. Right? The Fed can't affect really. It can do things at the margin and screw things up and misallocate capital, which it has done, but it really can't move that. Inflation is that determinant. And so do you have inflation? Inflation sets interest rates. And the Fed tries to influence inflation ineffectively. And so therefore things happen to it. So it's an interesting time in which we are. And I think potentially there's an inflection point. I think capital is allocated based on historical performance. And in spite of the fact that everybody will say past performance is not a predictor of future results.
But
And,
it is the best predictor. It's not a predictor, but it does happen to be the best predictor.
it's the best predictor until you reach the inflection point when the underlying fundamentals change, and then suddenly it's not a good predictor. So go back and tell the buyers of the Nifty 50 in 1972 that trend, which was a great trend, which was based on historical performance, was not, and it was a predictor of future results. Suddenly, it wasn't a predictor of future results. And I'm thinking we are more likely, given the extent of time that's happened, the allocation of capital, that there's some same things that change. And of course, a lot of assets are priced on the expectation, right? And that's priced in. There will continue to be that case. And therefore, that's not the case. That's a huge adjustment. Suddenly, there's a whole bunch of people swimming naked.
Oh,
And
yeah. I mean, I'm a huge believer that vintage matters and it affects the way people think about markets and the performance of assets. There's been a trope that it's like, oh, the bond guys are the smartest guys on the street. It's like, well, are they the smartest guys on the street, or did they just have a 40-year bull market in bonds?
well, so 2 years ago, we were going to have a recession. The recession was going to be predicated on the fact that the long bond was lower than the short. And of course, at the time, I said, that's ridiculous. What's really going on here is the inflation has happened. Short rates, you immediately turn over all the time. And so therefore, they're priced properly. And 5 is the right rate. And 3.5 on the 10-year treasury is not the right rate. But everybody holding that bond is hoping that inflation comes back down. So that pricing was predicated on the hope and expectation that maybe it'll go back to that number again, and a refusal to try to take the loss. And so therefore, that's why that was, I really do think. And of course, we've seen that now. Now we won't have a recession because now suddenly we don't have an inverted yield curve anymore. The short is it's getting longer. And so therefore, that means we're not going to have a recession. And all of that was the bond market was smarter and was predicting something. No, it was afraid and it didn't move, and it was tied to where it was. And the Fed was buying the 10-year treasuries to manipulate the market, and you bought into that because they'll be able to continue to buy it and keep the rate where it is. So I don't need to sell my bond. I don't have that much exposure in it. So there's a lot of misconceptions that happen on a regular basis that, based on past performance, they predict certain things. And bonds today are, risky for the point of view. You want to own a bond if we're going to have a recession because bonds go up, rates go down in a recession. But to me, that's a speculative investment. It's a speculative investment in this thing that's supposed to be secure and safe. You're speculating there's going to be a recession, and then capital will run to some place that they perceive to be lower risk. And I'd argue when they then drive it down to 3.5%, that's not low risk. 3.5%, 10-year or longer maturity bonds have a huge amount of risk in them. So maybe more than the Magnificent Seven in terms of valuation. So,
But the sentiment is pretty blown out. I was talking to somebody last night who said you could lock in 2.75% in 30-year tips.
mm-hmm.
If you're protected from the inflation, now obviously that's the government inflation number that you're going to get, but that's for a real return. Like, that's pretty good.
No. And
historically,
and of course, for 10 years, there was no real rate of return on the 10-year treasury.
Yeah.
Right. Which is interesting from the anomalistic point of view, right? Any investment. Well, what's my risk-free rate of return in a 10-year treasury and an equity investment probably is the base point. And what was the return in that? Well, it's like 0 to negative. So how do you build a foundation of then putting a risk premium on top of something that the foundation's in the wrong place? That is not a 0, and below 0 is not a risk-free rate of return. And that's what the 10-year treasury was priced at.
Totally. Well, Bob, where can people find you? Where can they find out more information about Robotti Advisors?
Oh, well, of course, we've got a website that's, pretty mundane. There's a bunch of talks I do that you can link to those things. I guess in the last year or 2, 3, I've been running my mouth more frequently. So there's a number of different things you can listen to me procrastinate. And even though I speak a little quickly, still turn up to speed because it's better. Short.
No, it's good. A lot of guys, you gotta crank it up to 2 times. I think you're more like a 1.25, 1.5 times. As a podcast host, it's always wonderful to have somebody who's got the 2x speed on automatically. So, okay. Well, thank you so much.
There were some great questions and thanks for giving me the opportunity to talk about something that I'm passionate about. Thanks.